Hello everyone. I will cover Chapter 8 in this lecture. This chapter is about stock valuation, and these are the concepts that we will cover in this chapter. So what is stock valuation in brief? Stock valuation means we try to compare the market price with the intrinsic value of a stock. So that helps us to understand whether the stock is overvalued and undervalued. And accordingly, we will decide whether to invest. So we value a company based on its future performance because uh, our expectations of the company's future performance will have an impact on its current stock price. And to do that, we look at historical financial data and try to project the future financial data based on that. So one way to do that is naive approach. So we look at the historical data and expect that sales, profit, and other financial items will grow at the same rate. The other approach is to look at sales, profit, and other items and adjust them as per the inputs from security analysis. That is, inputs from economic, industry, or company analysis. So how do we forecast future accounting items? So we use something called common size income statement. So we take the income statement and convert all accounting items as a percentage of the sales. So sales is 100% and other accounting items in the income statement becomes a percentage of the sales. We have a expectation about sales growth. So sales will increase, and we can also project other accounting items in future based on the sales. For example, in a certain year, we have the actual accounting items, and then we convert the income statement into a common size income statement. Sales is 100%. Other items are percentage of sales. So we have an expectation of sales growth. So we can project the sales in future years. We can keep these percentages same, or we may modify some of them based on our expectation of different items. Maybe we have different expectation for profit, different expectation for expenses in future, and we make certain adjustments. So now we have the sales growth, we also have the sales projection, and we have the common income statement, common size income statement. So at a future, for a future year, we have the estimated sales. We also have the net profit margin. We use these two terms to get the future profit. The next step is to forecast the dividends and price. To forecast the dividends, we need the future dividend payout ratios. So this ratio generally is constant and does not change much. Similarly, we need the common shares outstanding. So we assume that the number of common shares outstanding also does not change much. However, it is difficult to estimate the PE ratio. So how do we estimate the PE ratio? The PE ratio depends on different factors. For example, the growth in earnings, the economic and the business environment, the company's debt levels, and so on. But what we generally notice is high PE ratio means the company's earnings growth rate is high and it may have low debt. Also, companies with high PE ratios tend to pay low dividends because they have high earnings prospect and they want to reinvest their earnings in the business to grow. For the P ratio, we start with the average market multiple. So in this case, we get the P ratio for all stocks in the market index like the S&P 500 or the Dow Jones Industrial Average. And we compare the P ratio of the company with the market P. If the P ratio is high for the market, it means the market has a positive economic outlook. However, we must keep in mind that all high P ratios does not mean a positive outlook. In some cases, even during downturns or during recession, we can have high P ratio. For example, the financial crisis of 2008 and 9. Most companies had very low earnings, because of which the P by E ratio for the companies increased, as well as the market P is also increased substantially. So you can notice it in this graph. So we have the P ratio of the market index, S&P 500, and we see a significant increase in 2009. So we have the market P, and we also have the uh, current P ratio for the company, and we get the relative P ratio. For example, if the market P is 25 and the company's P is 35, so the relative P is 1.4. So higher relative P means the stock price will be higher than the market, or the stock price will be priced higher in the market. So now we look at how to forecast the dividend and prices. So one way to do it is look at the P ratio of the company and adjust it for future based on different factors. Then we estimate the earnings per share. So we have the net profit for a future year, which we have calculated from our projections. And we also have the common shares outstanding. So that will help us to calculate the earnings per share in a future year. Another way to calculate future earnings per share is return on equity into book value per share. So these values, the shares outstanding is assumed to be constant. Book value after tax earnings, these are based on future projections, which we have done in one of the previous slides using the common size statement. That is one of the approaches used. The dividend payout ratio is expected to remain more or less same. So we can estimate the dividends based on the future EPS and the future payout ratio. So we can also estimate the share price because we have the future EPS. So we have the future EPS, we also have the future P ratio. We multiply the two and we get the estimated share price at a future date. So what are the steps involved? So we first take the company's financial statement, we convert it into common size statement, and then we have a prediction for, or we have an estimate for sales growth. Based on that, we create common size statements for future years. Those future projections help us to get the sales numbers, net profit margin, and so on. Based on that, we calculate the earnings per share. From earnings per share, we get the dividends, and we also get the future stock price. So this is an example of how we have calculated the price for different the uh, P ratio for different years. Now, based on historical trends, we can create the common size statement. So we start with the uh, expected growth rate in sales. Based on that, we create the common size statements. So we have the net sales for future years. From that, we get the profits. We divide the profits by common shares, we get the earnings per share. We multiply earnings shares with payout ratio, we get the dividends. We multiply earnings per share with P/E ratio, and we get the future share price. So this is an example of how we can start with future projections and use different formulas to get the future dividend or the future share price. So this is how we are valuing the stock of a company. So the idea is, given the risk associated with the company, we find its stock price, and we try to figure out whether the stock price is justified by the risk associated with the company. So one way is to find the intrinsic value of the stock. The other way is to find the expected return. So we look at the expected return that we expect from the stock and what is the return that is being offered by the stock. We compare it, and that also helps us to take an investment decision. So one way is to compare market price with intrinsic price of the stock. The other way is to compare the expected return with the actual return from the stock. In either case, we are comparing the value of the stock with the risk associated with it, and we can decide whether it provides a good risk return trade-off. So how do we estimate the expected rate of return? So the expected rate of return is risk-free rate plus the risk premium, and risk premium is stock beta into the difference of market return and risk-free. So this gives us an expected return, and we can also calculate the actual return from the financial statements. So that's all for chapter 7 in this, or rather chapter 8 in this lecture. I will continue with rest of the chapter in the next lecture. Thank you.